Welcome everyone to this quarterly update from Leithner Co. Before we begin, please pause the video to read the disclaimer. In this quarterly update, we will cover the following areas. We'll look at the long and shorter term investment performance. We'll look at the dividend history, including recent payments. Then David will discuss actual and anticipated changes to the portfolio. And I will finish up by reminding interested investors how they may invest with us. So turning to the first slide, Chris, how have we gone over the long term?
Thank you, Chris. We're conservative investors and we've generated steady long-term returns. The graph shows that each $1 invested in our shares in 1999, dividends reinvested, grew to $6.78 on the 30th of June of this year. That's a compound annual growth rate, a CAGR, of 8.0%. Each dollar invested in a portfolio that mirrored the All Ordinaries Index, dividends reinvested, grew to $6.61. That's also a CAGR of 8%. The global financial crisis in 2007 to 2009, that's the biggest example. And the COVID crisis from February to April of 2020 is another. We've outperformed when the index has plunged. The extent and the length of our outperformance during and after the GFC is particularly worth noting. We don't fear bear markets, quite the contrary, we like them. That's because as conservative investors who seek to buy quality assets at attractive prices, they set the stage for long-term outperformance.
Okay, Chris, let's turn to the next slide. We slightly underperformed the All Ordinaries Accumulation Index. Does that matter?
All results matter, and consistently positive results, which means minimizing negative results, that matters most of all. The graph compares our total return, dividend plus capital growth, to the indexes over 5 intervals. In the most recent one, that's the just concluded 23-24 financial year, our total return was 10.9%. The indexes was 12.5%. So it's true that we slightly underperformed in 23-24, as we did in 22-23. It's also true, though, that in 21-22, we greatly outperformed. We gained 4.5% and the index lost 7.4%. And from the pre-COVID peak to the trough of the COVID crisis, the index fell 25%, whereas, and in sharp contrast, we lost just 5%. In each of these examples, our results are a consequence of our conservative philosophy of capital preservation. The first thing is to avoid losses. And then, subject to that vital caveat, we seek to generate gains. Consequently, over the long term, our shareholders have benefited from our steady results. We do best when the market does worst. Our disciplined conservatism is a key reason why we've matched the index since 1999 and outperformed it since 2020. We've minded the downside and let the upside mind itself.
Thanks, Chris. Let's now have a look at the portfolio's allocation to equities versus non-equities.
Okay, this graph plots our portfolio's allocation to non-equities, that's to say interest-bearing securities, bills, deposits, etc., at half-yearly intervals since June of 2000. We follow Benjamin Graham's 75-25 rule. Stocks should comprise at least 25%, but no more than 75% of a conservative investor's portfolio. Since 2000, our split has been approximately 50-50, and on the 30th of June of this year, it was approximately 59% stocks and 41% short-term bonds, deposit, and the like. The key message is that we've outperformed not despite our conservative asset allocation, but because of it.
Okay, let's proceed to the payment of dividends.
Okay, the most important point here is that since our inception, a quarter of a century ago, we've never failed to pay a half-yearly dividend. This slide plots the company's annualized gross dividend yield, that is, It's dividend, including franking credits, divided by the share's net tangible asset value, its NTA. Since the company's inception, the yield has averaged 8.2%. Over the past 10 years, it's averaged 6.0%, and in the just finished financial year, we're expecting it to approach 8%.
And the next slide goes into a bit more detail about the more recent payment of dividends.
That's right. During this time, our dividend per share has trended upwards. It's important to note that the dividend that's payable for the January to June half of the just concluded financial year is an estimate. It's a reasonably close estimate that'll be finalized during the next week or so and will be paid to shareholders on or about 15th of August.
Thanks, Chris. Now, David, let's turn to some of the actual and anticipated portfolio changes.
Sure, thanks, Chris. A couple of changes. We might go to the last one there, Woodside. So effectively, we sold puts over Woodside, one of the top 10 producers of gas in the world, long life assets. Market hasn't liked a couple of short-term issues that have happened to it, but longer term, which is what we focus on, we believe we'll get solid returns. So we've been buying more. We're probably at around the position that we want longer term, so we're quite comfortable with that. So that was on the purchasing side. On the sale side, we've looked at the banks, somewhat surprised. When we bought them, we bought the three banks which we thought were the best value, ANZ, NAB and Westpac. We didn't believe Commonwealth Bank was as good a value as those three. Commonwealth Bank has outperformed. There are reasons for that. From our analysis, the reasons it's outperformed are largely that it's geared more heavily than the other three banks, because most of its asset base is in home loans. Notwithstanding that, we've looked at the banks where they are, and as we do with all of our holdings, we regularly run them through a similar process to what we run them through when we purchase them. So we go forward 5 years and work out what the returns are likely to be to us as owners for the next 5 years. And that's just a realistic calculation. It won't be exactly right, but it's what we realistically think can happen going forward for those stocks. So we focus on those three banks. If we have a look at the next slide, basically we've got valuations. We do two different versions, and then we come up with a blended valuation down the bottom. So we use discounted earnings going forward 5 years, or discounted equity going forward. And then we use discount rates, so 5, 10, 15% for each of the banks. When we're purchasing a stock, we're looking for a discount, a return. So we use a discount rate of 15%. So we're looking for a good return from these things, good return from solid, secure assets. When we're looking at selling, it's similar, but it's the reverse. So if a stock that we own, or a share of a company that we own, has a forward return of 5%, say, or less, we don't think it's worth the risk. If we're expecting to get 5% returns from something over the next 5 years, we can get that from cash without taking any risk. So if we have a look forward down the bottom of the valuations using 5%, we're looking at $30.58 for ANZ, $32 for NAB, $27 or so for Westpac. The prices were around this area. So we started exiting the positions, and we did that by selling calls over them. So if we go to the next slide, what we've done is sold all of the positions, and we used a strike price for ANZ of $28.50. For that, we got premium of $2.08. So total proceeds of $30.50. NAB, similarly, total proceeds of $38. Westpac, similar total proceeds. What we've done by selling calls, we've got slightly higher than we would have got on the day we sold them, so slightly more total proceeds. We've also protected ourselves a little bit in case the market kept rallying, which it has a little bit. The downside we've got is if the market does fall, they may well fall down below that. That then allows us the position to sell more calls over those holdings. So the way the market is at the moment, we expect we'll exit those holdings in the October period there. If the market falls back, we won't. We might still be holding those, come the 18th of October. But if that happens, we can then sell another option over each of those 3 stocks. As you can see, the holdings since we purchased, the price is reasonable. This was a sort of COVID purchase around 2020. So the compound average growth rate since we purchased them have been in that low 20s to high 20 range, which is good. And we're entirely happy with the way that turned out.
Thanks, David. To summarize, we have a healthy amount of cash to place into suitable opportunities should they arise at around 40%. The yearly dividend continues to grow nicely and is consistent with the long history of paying dividends. Our current net tangible assets are just over $1.02. The market capitalization currently sits at just over $30 million. And a reminder, we intend to soft close the investment company at $100 million. If you're not a shareholder, please make contact with either Chris or David, who are more than happy to discuss the investment approach and the steps to become a shareholder. A reminder to existing shareholders, you can always reach out to the managing directors if you have any questions. I'll finish with the contact details. Thanks to everyone for your interest, and we look forward to our next update in around 3 months' time.
Thanks, Chris.
Thanks, Chris.